Hey everybody, welcome to Mortgage Today for Friday, March 8th, 2024. And oh, what a day it was. UMBS were up 6 basis points on the open. Stock futures were up as well. Bonds were just a hair better than unchanged ahead of the NFP and initially shot well into weaker territory after reading the top line of the report. After all, 275 versus 200 would be a good result to sell bonds. Would be a good reason to sell bonds. But the details of the report were more bond-friendly, with revisions to the last month being far lower than today's beat. Wages at 0.1 versus 0.3 is also quite helpful, not to mention another tick up to 3.9 in unemployment. It's a bit of a juggling act to decide how to trade it, but the market isn't staying too far from unchanged. But the market wasn't staying too far from unchanged right after the report. So basically, non-farm payrolls came in at 275,000 versus 200,000. Last month revised down 229,000 from 353,000. Unemployment rate came in at 3.9 versus 3.7. Forecast was 3.7 previously. Wages came in up 0.1 versus a 0.3 forecast. It was 0.5 previously. Year over year, they're up 4.3% versus 4.3%. I feel like this wage percentage component is the thing that's going to drive when the debt apocalypse comes. Jerome Powell said yesterday that the Fed is close to cutting rates. I think we are in the right place, Powell said, of the current stance on monetary policy in a hearing before the Senate Banking Committee. We are waiting to become more confident that inflation is moving sustainably to 2%. When we do get that confidence, and we're not far from it, it would be appropriate to begin to dial back the level of restrictions so that we don't drive the economy into recession. In January of 2023, when the labor market was sizzling, year-over-year wage growth for those employed during the previous year peaked at 6.4%. Among those that changed jobs, it was 7.7%, and among those that didn't change jobs, it was 5.7%. By January of 24, overall year-over-year wage growth weakened to 5.5% for switchers. It was down a stunning 1.6 percentage points to 6.1%, but for stayers, it fell 1/3 as much to 5.1. It seems weird to consider, but Friday trading, and indeed the week's trading as a whole, was fairly logical. By the end of the previous week, economic data provided evidence that rates didn't need to go any higher. This week's data didn't exactly confirm that in an overall forceful way, but it absolutely didn't offer any arguments. Friday's jobs report was the latest and most interesting example, with revisions, unemployment, and wages doing more than enough to offset the higher headline compared to expectations. After today, the past 2 months of NFP readings make a lot more sense. It also makes sense that bonds rallied modestly. 200,000 is still strong, but sub 4% unemployment is still low. But it's next week's CPI that truly determines how quickly we can forget February's unfriendly data. UMBS closed out up 6 basis points at 101.09. So at 101.09 on the technicals, that is putting us right above this 50-day moving average line, which is still underneath that very tough technical ceiling at 101.392. So we'll have to see what happens with CPI next week, which, as a reminder, comes on Tuesday. So Tuesday is that big CPI number. We're also going to get an auction right after it, so we'll get a real-time look at what the market is thinking from that. Then on Wednesday, we get some more auctions as well, and then continuing claims, jobless claims on Thursday as usual, but we also get retail sales of producer prices. So a lot of stuff coming next week, and for things you can control, it's how well you approach life and your sales. You can step up your sales game with insights from the Fifth Agreement. This isn't just a book, it's a strategic ally in your journey towards sales mastery. So check it out, our sponsor at wellthatmakesense.com, and all of our other common sources and influences.